There's always a way when there's a will. I appreciate being here with everybody. Over the years, we have been an investor in many asset classes and categories, primarily real asset and growth. And about 7 years ago, we found an opportunity in a growing industry that was health and wellness. And the approach we took with our family offices and sort of our institutional background was to look at ways to invest in the alternative and emerging wellness category with a mindset that, we would be very broad-based and we would only invest in things that we thought had federal clearance. And so some of the stuff around the cannabinoid business or the hemp business made a lot of sense to us, and they still do because of the political nature of the growing market. It's very uncorrelated to the broader markets in terms of what's going on in Wall Street, geopolitical issues, supply chain issues, more so correlated to policy. And when policy allows for health and wellness companies to grow and new states to become part of the equation, revenue grows. And that's grown at about a 20% clip year over year. So, Marty, to answer your question, we don't invest in a cannabis company. We define those as companies that operate with cannabis. Rather than that, we think of ourselves as a health and wellness supply chain investor. So we invest in data, analytics, hardware, software, CRM, inventory management, biogenetics, biosynthetics, and a variety of these types of companies. And a lot of these companies have some service that they provide to the cannabis and hemp space. That being said, they provide services to many other sectors, and some of our companies are, more aligned with science and biosynthetics and things like alternative to plastics and much more broad in terms of category.
Fantastic. And is that equity or debt?
Equity.
Fantastic.
Yeah, oftentimes we look at convertible notes, different types of structures to protect some downside while still maintaining upside. But our philosophy when we're looking at growth industries, emerging industries, is that we don't want to limit the upside by protecting downside too much. There are a lot of ways to invest credit and debt, and you want to be able to have a great underwriter to do those things. When you look at an emerging industry and you're talking to allocators, which I've always been on the allocation side as well, and you look at alternative asset classes, especially in emerging industry, we'd like to think that 2 to 3% of your allocation should be in a category like this to generate outsized returns. So, Marty, that being said, I think when you're playing emerging industry, you invest as such because you want your returns to be outsized as compared to the 95% of your other portfolio. And I think that's where you do things like credit, public markets, bonds, mutual funds. Those are ways that you aren't looking to generate 20% returns. And when you invest in emerging industries, that really is your focus.
Matt, that's super exciting. So can you talk a little bit about your deal flow and what are like the intrinsic, things that you look at when you're looking at a deal that you think are valuable? And I've been asking everybody all day long, talk about a deal that you love.
Yeah, deal flow right now is really interesting. There's no shortage of opportunities out there with markets the way they are, and investors being a little bit more prudent than they've ever been or cautious. And so we're seeing more than we've ever seen before. So we got to be very careful, make sure we do proper diligence that we always have, but even more so. And so in this type of market, you're wanting to lean into companies that do have cash flow, hopefully even break even from an EBITDA standpoint. And you can find some discounts there. There's a lot of investors on these cap tables that, from a secondary perspective, are encouraged to sell positions in a way that they weren't otherwise. So we're seeing a lot of that. And I guess the other good thing, Marty, when you look at emerging industries, you're thinking years out, 2, 5, 10 years. And so these market cycles are an opportunity to kind of really get the structure and the valuation that you want on a deal, and be able to think about things in terms of where they're going to be in 5 years. I think in some categories where you don't have that long of a return profile, I think you're a little bit more, optimistic in terms of what things look like 6 months and a year from now, and the way you view a particular category. But for us, a lot of things we're doing, we're thinking a little bit further out.
So your typical horizon is a little bit longer than 5 years. Is that correct?
In many cases, right now, I think we're being able to get into later stage rounds that have growth in a way that makes sense. But I think in the past, when we looked at opportunities, we really did have the ability to look 5 to 10 years out, and that way you get through a cycle. You can look on the other side of a cycle. So we're seeing a lot of deals from every aspect. I don't think you're going to see as much appetite for startups right now, and that's not because some investors don't think about the long-term aspect as well. But at the same time, if you're getting value in a growth company that has some metrics that are pretty exciting, it's difficult to pass that up. So you're going to see later stage companies get more attraction than the earlier stage companies, and I think we're starting to lean in that direction as well.
Are you typically the lead investor or co-investor? And if you're a co-investor, who do you co-invest with, or who co-invests with you?
Yeah, co-invest is a big part of what we do. I will tell you that when you're investing in venture capacity, that's a big piece of the upside, is being able to hedge your investments and diversify your investments by not having to take a majority stake and allowing other strategic investors to be a part of that. Said another way, I had a mentor of mine talk about the kind of mid-90s, and in that way, here, let me just switch over to my computer. Sorry, guys. This will be a little bit better.
He's there and he's back.
Okay, much better. So I think that when you are able to invest with other smart investors, you really give yourself a lot of upside in the event that you have the old 80-20 rule when you're doing emerging industry investing, which is 20% of your companies tend to be 80% of your return. And in that way, you aren't supposed to know exactly who the winners are at any particular time in the early stages. So if you look at the 90s and you thought that the internet was going to be a big thing, you would go out and you'd build a strategy around investing in the internet, and you would invest in Google or Yahoo or any of these other internet browsers, of which there were a lot. You can't quite possibly know at the particular time you invest in an A round or a seed round of Google that it would be what it was back then. But if you invest in 5, 6, 7, 8 internet browser companies, and you invest in 10 or 20 companies that are widgets in that category, over time, you start to see who the winners are. And what other great investors do on a cap table is help bring an industry together through M&A to create that winner. And you could look at like MySpace and Facebook as an example. There was a time where you didn't know which of those two companies would be a big winner, and you invest in both. And then over time, you really start to see that Facebook's becoming a winner, and you lean more and more into that investment. If you're investing in an emerging industry and you don't know who the winners are going to be, you really don't want to be private equity minded, where you take over 50% of a company, because there's just too much downside. So allowing other great investors to be a part of cap tables, investors that are looking throughout a category, trying to bring in value to that business, both through M&A and just strategic advice and boards. Then that allows you to get to the B round, the C round, the D round, the pre-IPO round, where these companies get bigger and lean in and write a much bigger check. So we like working with other investors. I think they like working with us. And that's sort of the approach. We do take a lead position, but not like private equity. Lead meaning we would go in and be the majority check on a particular round, maybe even co-lead, and then bring in other smaller investors who may provide some type of strategic value as well.
Can you talk about the, I'm sorry, we have a question from the audience.
Hey, Matt, how are you? Can you hear me okay?
Yes.
Terrific. Your personal liquid net worth as well as your partners, how invested are you in your own fund? How much of cooking are you eating, your own cooking?
It's a great question. We always try to be 1 to 5% of the fund. That way investors know that we have capital in, and we commit that from the very beginning, not the end. And so we're always the first check in. That being said, there are 5 to 10 families that we've worked with for a very long time who do the same thing. They like to come in early, and even though it may not be my own personal net worth or some of the partners, it feels that way because they're folks that we've worked with for a long time, and they are truly family. So what we try to do is be 1 to 5%, and then kind of have the core lead families that we work with be roughly 20 to 25%, so that the strategy is often going, and the remainder in the 50 to 75% range tends to come from other friends and family or new friends along the way.
We know that federally, the cannabis industry is not, regulated across states. I can't move product to product. I can't take my product from, California to Arizona to Nevada. So obviously the gates are up. But when those gates come down, how does your investing parameters change? If I'm allowed to take my cannabis from Bakersfield and bring it to Scottsdale, how does that change your theory of how you're going to be investing in companies?
Well, it's an inevitability. There are a lot of states talking about doing that right now, and it doesn't need federal clearance to do that. You're going to see some states like Oregon who are reaching out to neighboring states. California is trying to do this now with neighboring states. So, and I think in the Northeast, you're going to see it too before the federal situation happens. That being said, it doesn't really change things for our investing friend. And the reason is because we don't invest in an operating cannabis company. We invest in companies that serve some of the cannabis companies and other industries. So we're predicting that there's going to be a consistent growth curve like there has been with new states and new cities coming online. In California, I don't know the exact number, but I would say probably 60% of the state allows for business. And I know this doesn't answer your cross state lines, but still within different jurisdictions, there's maybe 40% of California that doesn't allow for this industry to take place. And so there's a lot of growth to happen in states and with new states. And when you can cross state lines, then you start to develop a normal supply chain, more predictability. States like California, I just saw a question pop up that, today produce, I think 80% of the entire country's fruits and vegetables are in a great place to be a large supplier, because right now there's only a limited amount of demand in one state. So we think there's going to be a continued growth curve. When this cross-state lines business starts to happen, I think the only thing that really changes is that the states that are able to have the ability to do a lot of supply become a little bit more appealing, and then the states that don't become a little bit less. And you have to think about it in terms of branding or store frontage or other types of business, just like fruits and vegetables. The fruits and vegetables was not a great business in Chicago, which is a great market for cannabis businesses right now. So right now, the state of Illinois has to grow its own supply. It doesn't have to grow its own fruits and vegetables for every store in Illinois. So there will be states that are better for supply. But I don't think it changes the actual demand opportunity within a state, it only benefits some of the states that have ability to supply.
Follow on question. Let's say it's federally approved, money can move through the system. I can bank, my cannabis profits, et cetera. I can, go to the bank and instead of having obviously to work with cash. All of a sudden the rules have changed. Big tobacco starts to step in. All the big tobacco companies have geared up. They're buying, hundreds and hundreds of acres all over the country. When they step in, again, back to you, how does your parameter of how you're going to invest in those companies change?
Well, it's a great question. Frankly, I think that's a catalyst for exits. I think a lot of people that are investing in these categories are really looking at institutionalization as sort of a peak value moment. So if you can capture market share, for example, we have a company that does payroll and HR, and right now they're around 80-something% of every cannabis operator over 100 employees. And so the minute that you can start doing some of the federal work, that company is probably acquired by ADP. In fact, they're already in conversations for when that happens. So it definitely changes the way you invest because the Fortune 500s will come in and acquire. But until that happens, I think that's why you're investing. You're investing with the thought that these larger players will come in and do some acquisitions. Now, that being said, if you talk to the people that invest in the cannabis side of things, like an operator, I think they get big enough where it's really its own industry, it's its own business, and they may or may not get acquired by a tobacco company or a pharma company. They may stand on their own. So we'll have to see how that shakes out. But for the way that Arcadian invests, our philosophy is whether it's for cannabis or hemp, whether it's for alternative medicines or alternative building materials, any of these kind of emerging consumer health and wellness categories, our belief is that the commodity element will ultimately become just that, a commodity, and it'll be commoditized, and the large players will come in and do a lot of that work. But when you go back and look at trades that happen, just take Oracle or Salesforce, for example, how many SaaS companies do they acquire over the years? And if you can build a SaaS business, for example, in a category that they do not offer service for, and you can be a market leader, you become very attractive for a high multiple exit at that time. So I think that's the way we're thinking about it. I think institutionalization is where you really are building towards. And after that point in time, it's an entirely different situation. And I think you have to kind of see what that looks like. And it just doesn't happen overnight, by the way, with one piece of legislature. It's going to keep being piecemealed in. And so there's not just one event that's going to do it. It's going to be several. And when you're building companies like us, that really is your exit point, I think.
Hey, Matt, so, most of the venture world is experiencing like a repricing or a mark to market. We just had a guy talking about venture debt who said that, when he is calculating his debt on the ventures he's investing in, he's marking everything down by more than 50%. Are you seeing the same thing happen in the areas where you're operating? Are valuations coming down dramatically from the last rounds?
They certainly are as a general statement. That being said, if you've done, proper diligence and really fought for valuations along the way, you're not in too bad of a place, from an emerging industry perspective. If you look at the general tech sector, of course, they're going to be written down because you had so many funds that raised so much money, they just needed to deploy it. And they didn't have a lot of leverage in terms of how they value the business. I mean, look at Uber, for example. Uber didn't even generate a profit until, I don't know, a year or two ago. And so you have this amazing company that changed the world that didn't make a dollar for 20 years. And so if you go back throughout all of human history, it's about generating some type of profit or some type of trade that makes sense. And what happened is we just got carried away with valuations broadly. But I think if you were a good investor, you knew this day was coming, and you have to look at profitability and metrics in terms of multiples on that profitability that stand the test of time. So I feel like in our portfolio, we don't have a tremendous amount of companies that are valuing themselves at 50% less than they were, because I think we were very prudent with making sure that we didn't get invested in companies, even if they were great companies, that were astronomically overvalued. We are seeing some rounds at par to the last round, and companies offering incentives to come in. But I think for the most part, Marty, you're going to see repricing across the board. But I think in our companies, we probably have less than a lot of managers do.
There's been some interesting trends in the market. Is the space that you're in impacted at all by this reshoring, manufacturing coming back to reshoring, or things along those lines, or just demographics of the country demographics? Can you talk about that? Maybe there's a wellness aspect to an aging population.
Yeah, there really is. I think COVID was a big moment for the health and wellness category. People wanted to find as many ways as possible to be healthier and more well with their life, and also had the time to kind of search about these topics and learn what worked for them and what didn't, and try things out. So I think the aging population and COVID and everything that went with that was a big proponent of general health and wellness. I think outside that, some of the changes in supply chain definitely had some effect on some of the companies. We have some hardware companies, for example, that got a lot of their products from China. And so that was a little bit more difficult. I think if you look at cannabis and hemp, it's not an international supply chain business anyway. So most things were done hyper locally. So I think it had much less effect than it did to other spaces that had already built out, a very complex international supply chain. And when you look at some of the pharma and biosynthetic companies we're involved with, there was some effect there, but I think a lot of that was hyper localized as well. So the demand has continued to rise. I think you're seeing a lot of this be sort of uncorrelated to geopolitical issues, more local issues, and from a supply chain perspective, some issues for sure, but I think again less than some because of the localized nature of some of the businesses we invest in.
Sure. Can you talk about your deal flow a little bit, like where it comes from, et cetera? And also I have a question, when you're looking to invest in a deal, like, I know there's crowdfunding everywhere. How important is who's on the capital stack with you when you look to invest? Can you talk about that?
Yeah, it's really important to us because we're now kind of a mid-stage growth investor. We really don't do a round that's the first outside round of capital. It's really important to us that we were able to talk to the previous cap table. What was their experience like since they made the investment? Are they happy with not only the results, but the way the team handled themselves? And so that gives us an opportunity to get involved in a business where there's already an existing cap table that we can speak to. As the business grows, depending on the category, we want to know who's coming into the round with us because they have a different level of expertise. If you're doing a pharma deal or a software deal, it's a very different type of investor from a skill standpoint. And you really want to understand that if you're going into a deal and think you are pretty smart, that there's other really smart people that are going to add value to the business. So that being said, deal flow comes from those areas a lot of times. Other funds that we're friends with, will talk to us about something they're doing. They feel the same way. Hey, we want you guys involved. You got a great team, good track record. We don't want to take the entire round. So we do want people in there are going to be friendly and add value. So a lot of deal flow does happen amongst investors like us. That being said, I can't believe how many resources there are out there right now for entrepreneurs to find capital providers. And so on a daily basis, I don't know how they get our information, but they do. And opportunities just come flying in to all of us, especially the investments team. So I think through COVID, there's probably a lot more of that. People had to find ways to electronically connect the dots for investment opportunities and investors. So a lot of deal flow there. And then a lot of deal flow just comes through having a legacy and a reputation. When you've been around a little while, other founders, have friends, people leave companies, start something else. And so it's just your internal network is where you get a lot of it, maybe not as much as the unsolicited or, through various networks, but when they come from a company or a person you've been involved with, certainly there's a lot more comfort. There's a lot more comfort when you're working with somebody who you've already worked with that's somewhere new or has a suggestion to look at something. So there's a lot of that. And then you get to do things like this. We're certainly of the mindset to show up for, great gatherings of people. Our email, if you want to reach out to us, is investments@arcadiancap.com. That, or you can email me directly, Matt, M-A-T-T, @arcadiancap.com. This is also where we find a lot of investors. Investors want to invest with fund managers. So I think the other thing, Marty, is just showing up and talking about the story. And in that way, we can find really good deals. And we have a lot of investors reach out to us as well to invest with us. Maybe the last thing is, like most shops, we're pretty active out there looking. We've got people on the phone, talking to bankers, calling companies that we see in the press or the news that have something really interesting going on so we can find out more. So the other way is that, we try to remain active in conferences and webinars, and just general outreach from our deal team.
And so that last question is, you're looking at deals, you have co-investors who probably you invest with over and over again on different deals. From a co-investor point of experience, is it from your own personal point of view, and the answer means nothing, it's just relevant. Do you feel more comfortable with a co-investor who, all you've ever done is make money with them? Or do you feel more comfortable with a co-investor who you might have gone through a shaky time on a shared investment and, vis-a-vis, dialogue you had with that investor, you were able to get out of the investment in the right way, steady the ship, et cetera, et cetera. Because obviously there are times, look at Silicon Valley Bank collapse, where things happen and you have to be able to handle the emergency. A couple of weeks ago, we had a billionaire billionaire investor speak to our group, and he was like saying we were on the phone when Silicon Valley Bank was collapsing with every one of our investments, with Tim Draper, sorry, and he said, and we were trying to figure out how to get them lines of credit so they could pay their payroll. So, does that help you feel better and your co-investors when you're able to navigate that kind of stuff, or your thoughts?
Yeah, it does. I think a lot of times our investors themselves are a great resource. We want to work with other great families, other great investors that invest in our funds, because they know that when stuff happens, that they have a particular skill set. We have some big insurance companies that invest with us, and they're great insurance needs, and they can really help do those things. Or we have some, really experienced consumer product investors that invest with us, and when there's a problem with a consumer company, they're really helpful. So I think the first part of that answer, Marty, is that as a fund manager, we bring investors into the fund, and then we allow them the first rights to invest in direct opportunities, SVPs. We allow them to participate in solving problems or helping grow companies. So I think our greatest comfort level comes with the partners that we invest with within the fund or our vehicles. Outside of that, I think if you're making money with someone, that's a great thing. If you've gone through a fire and they've helped get out of it, that's also a great thing. I don't know, that one's better than the other, because you don't always make money. You can't expect to when you build a strategy like a fund manager does. So I think it's great in both cases. Like anything, as a former football player, you're going to go through trials and tribulations, and times are going to get tough. You don't always just win easily. So I think when you look around, when you huddle back up, you look at the people that stood next to you in the line of fire and got through it, you do have a tremendous amount of respect. I would imagine it's the same with military, right? You get through these situations, and the sort of community you build that went through it together is extremely strong. So it's really, really important to have the right team in your own organization or other people on the cap table to work with. There's no question about that.
Fantastic. Matt, you're in Newport Beach, you're Orange, Irvine, where are you?
Los Angeles, and we have a presence in some other places like Texas and London, a little bit East Coast.
In Beverly Hills, right, exactly right. Well, fantastic, guys. Listen, Matt, great talking to you, and thank you so much for making it. And we'll be seeing you at another event, I'm sure, in the near future. So thanks.
Yeah, absolutely. Guys, reach out to us anytime. Again, Matt@arcadiancap.com. We'd love to work with you as an investor, or if you're an entrepreneur, and we'll make sure that the right people on our team are available. And Marty, we appreciate all you do, bringing people together. You're a rare breed of facilitator and connecting dots. And in times like this, community is really important. Stronger together. And what does Mike Tyson say? You don't really know who you are till you get punched in the nose. And I think everybody out there feels a little bit of that right now. So there's certainly a lot of opportunity, and bringing people together will, not only create opportunity in the long term, but I think it'll be something that makes the world a better place if we do it together versus independently.